Okay, so let's get started. So like I said, for some of you, hopefully this is like a nice breeze. You're just enjoying the lecture today because you just know it all already. So again, we're starting off with Chapter 3, which is the Accounting Information System. Next class, we get into Chapters 1 and 2. And I will tell you that we will be doing some problems today. So hopefully some of you, show of hands, who has a textbook already or some kind of access to an ebook? Not a lot of you. Okay. All right. Well, we're going to be doing some problems today. Maybe I can figure out a way to sort of get something up online so you guys can see it. Maybe I'll try to do that. I'll try to go into My Wiley Plus, and so we can you can have access to the problems that we do. We'll figure that out when we get there. Okay. I was going to tell you to look on, but that would be a whole lot of people looking on with not very many people. So, all right. So let's start off with some real basics here. So you're in intermediate accounting. What is accounting? Okay. Well, we know we have to always account for transactions. When you're in a business, things happen, right? You make sales. You own a store. Someone comes in. They buy something from you. You made a sale. Okay? You have to account for that sale as revenue. You have to account for that cash received, right? You're going to be putting that into your bank. Accounting tells us how we are supposed to account for those transactions. Okay? Many of you will choose to become auditors when you finish your accounting education. So if you become an auditor, you're going to be reviewing the books and records of companies. So if I said someone owns a store, someone comes in, you make a sale, they give you cash, you have to learn how to record that as a person who works for that company. An auditor would come into that store and review your books and records and say, well, have you accounted for all of that stuff correctly? Okay, they come in, they review your transactions, they review your controls, okay, and they eventually assess an opinion. Okay, they issue an opinion on whether or not your financial states are free from material error. Okay, so when you hear about auditors and what they do, a lot of you probably go, well, I'm probably going to be an auditor someday, and then you go, I really don't know what that is. Okay, that's what you do. You go into different companies and you look at their books and records and you determine whether or not they are complying with GAAP and whether or not they have misstatements in their financial statements. Like a misstatement would be if you found out that if someone came into that person's store, they made a sale and for $100, and you find out through looking at their books and records that either the sale was improperly recorded or maybe that person came in to settle a bill for $100, right? There was a receivable out there for $100. Maybe they didn't properly remove the receivable. These are the kinds of things that you look at. So maybe cash is not correct. So as an auditor, you look at you look at the books and records of a company and you determine whether or not they are misstated, materially misstated. Okay. So separately from that, as I said, if you're the person who works in the store, you're actually going to be entering that information into an accounting system. So these are different career paths that you can take as an accountant, as you pursue and finish up your degree, right? You can work for a company, you can work as an auditor, you can work as an auditor and then eventually work for a company or vice versa. So I say here, it's very important that we understand how to properly account for transactions, whether we work as an external auditor or internal to a company, right? Because if we're internal to a company, we have to know how do we do it correctly so the auditor doesn't find errors, right? And if you're an auditor, you have to be able to go into a company and say, I know that that's right or I know that that's wrong. So you have to understand how to properly account for things. So why is this important? So who cares? So they forgot to record a sale. So they didn't get rid of the receivable, so their cash doesn't balance. Why does any of this really matter? So ultimately, all this accounting data, all these individual transactions become rolled up into the financial statements, right? What financial statements? Can anyone name some of the financial statements? Income statement, balance sheet, statement of cash flows, statement of retained earnings, or statement of stockholders' equity. There are all these statements, right? What is that made up of? That's made up of transactions that are just accumulate over time, right? And ultimately, the data is rolled into those financial statements. So if you don't make the right transaction, your financial statements will be wrong, okay? And I'm giving you a small $100 example, silly little thing in a store, but you look at big companies, they have millions of transactions that are going on. If you have a lot of errors, this could really mess up and materially misstate your financial statements. So again, still why does that matter? Because who cares who's looking at them, right? Right? Investors and creditors, external users of your financial statements are going to make decisions based on those financial statements, right? So investors might invest in stock. Creditors, an example of a creditor would be like a bank, right? You're a company, you want to go to the bank, you want to get a loan from that bank. If they see that you have a whole lot of debt out there and not a lot of assets, are they going to want to lend you money? No, and if they do lend you money, are they going to give you a favorable rate of interest? No, because they look at these things. They look at ratios. You can even take that down to an individual level, right, that you can maybe relate to. I can tell you, I was thinking, how to get a car. So I went to the bank and I was curious, what can I get a car loan from the bank? And they said to me they want to understand, they want to check my credit, all this kind of stuff, and they want to look, because they want to look at ratios, they want to look at my financials, they want to understand what kind of debt I have in my name, and they want to understand what kind of assets I have against that debt. And if I have more debt and not a lot of assets, they're going to charge me the same thing, a higher interest rate. So you'll see this happening not just at a corporate level, but you can relate to that. It makes sense. Right? Why would a bank lend you money? So these financial statements give these creditors, banks and other creditors and investors this kind of information to let them know whether to invest with you, whether or not to lend you money. And without having money, can a company succeed? No, this is how companies grow. They get investors to give them money. They get creditors to lend them money. Okay? So this is a very important point here. We have accounting rules. Do you guys know what the accounting rules that we follow are called? GAAP, right? We have our U.S. GAAP. Okay, and these rules tell us how to account for different transactions. But we have this sort of ethical dilemma here. Accounting rules can influence the decisions that we make as either internal or external users. So I say here, as an internal user, you may favor a rule that helps you to show higher expenses, because what do higher expenses give you? Lower net income, which ultimately you pay taxes on that net income, right? So you have to make choices as an accountant. There's judgment involved. I may choose to do something that will give me higher expenses. I'll give you an example in a second, where on the flip side of that, external users would see additional expenses, higher expenses, and say, I don't want to invest in that company, right? Because their bottom line is not as good as maybe a comparable company that made a different accounting choice. So I'll give you an example. I think fixed assets is a very good example, right? So if you buy property, I'll tell you, even when I was working as a controller out in California, there was a purchase of property, a very large property. I think it was 80 acres in the middle of LA, and on it there was land and there was building. What do you think was the most valuable thing, just intuitively, about that site, that 80-acre site? The land or the building? The land, for sure, right? But we had to use judgment in allocating between land and building, right? Now, what can depreciate? What can't depreciate? Right. So what would be more favorable for tax purposes? Allocate more to building of the purchase price, right? And we're going to get to this in our acquisition of assets, right? But this is a very real issue that many of you will have to deal with in your time when you are working in accounting. As an auditor, you'll have to evaluate the choices that are made, okay? And as a person working in a company, you have to make the choices and then support them, right? Because as a person working internally for a company, I want to get as much allocated to building as I possibly can, because that building is going to get depreciated, which is ultimately going to lower the tax liability for the company that I work for. Okay? So there's judgment calls that you have to make as accountants, and you have to make sure you try to make the most ethical decisions, which again we're going to talk about later on. But the idea is that accounting is not so cut and dry, right? You have rules, and you have to use professional judgment in implementing those rules. Okay? All right, so let's keep going here. So the fundamentals of accounting. So again, Just some stuff here. Accounting is the language of business, right? Everybody speaks, well, not everybody speaks accounting, but this is what people look at in the business world to try to understand how a business is doing, right? They look very frequently, they also look at other things, but accounting is one very important component of what interested parties look at when they're trying to understand how a company is doing. We have the accounting equation, which all of you should know. Right, I have ALLO here. Assets equal liabilities and owner's equity. Okay? Owner's equity, stockholder's equity, it's all the same thing, which I have on a slide subsequent to this. Okay? So accounting captures the economic events of an entity. So everything that happens, right, I've kind of already said that. There's a lot of redundancy in these slides. There's different ways of kind of saying the same thing. Whatever happens in a business is an economic event that has to be captured, right? And you record that in accounting, through accounting. So another thing, a fundamental of accounting. What are the assets that I have? This is another way of looking at it. And how did I pay for them? Okay, you have to record. What assets do I have? How did I pay for them? Did I pay for them with debt? Did I pay for them by investing money in the company? How did I get those assets? Okay? Any questions so far on anything I've talked about? Okay. This is so funny. I have are my glasses messed up, or there just are 2 slides up there? This is first of all, this is such a bizarre classroom. I usually have I'm just pacing, but I don't know where to go. I have 3 steps, and I'm on one side. I don't really want to go up the stairs because I'll probably trip and fall. So it's like the first row is going to just see me constantly walking back and forth because I don't know what to do. So anyway, so what is an asset? Definition. An asset is a resource of the firm that will benefit the firm in the future. Right? So let's name some assets for me. Let's think of how they fit into the definition. Cash. You have cash. It's a resource of the firm. It will benefit you in the future. Why? You can buy things that are, right? You can buy inventory, right? You can pay your bills. That's a benefit, right? That keeps you going. Got to pay those bills in order to stay in business, right? Name another asset. Inventory, accounts receivable, equipment. These are all great ones. So let's start with equipment, right? Equipment, a resource of the firm that will benefit the firm in the future. Why? You can produce inventory on it. That's great, right? You can't be productive if you don't have a desk to sit at work, right? It benefits you to have somebody who has a desk to sit at so they can be productive in working, which helps the company move efficiently, right? You said accounts receivable. Accounts receivable will benefit the firm in the future. Why? Turns into cash, right? That's your bread and butter right there. You need that money so you bring in money from those receivables. What did you say? Inventory, right? Why does inventory benefit you? You can sell it and make money, right? So these are all different kinds of assets that all will benefit the firm in the future for different reasons, right? Okay, but they all fit that definition of an asset. All right, so I have some examples of assets, but you already know them because you said mostly all of them. Cash, accounts receivable, investments is an asset, and are assets, right? Like stocks and things. We said inventory. Prepaid expenses. Prepaid expenses are an asset. I can see maybe, especially people who haven't done this in a while, prepaid expenses, that can be confusing because there's the word expense in it. That is still an asset. Prepaid expenses are an asset. What would be an example of something you might prepay? Insurance, of course, right? They give you that insurance, right? You pay your premium for the year, but now somebody owes you a benefit for the whole year. It's a resource of that firm that will benefit you in the future, right? Because you're now covered by insurance for a period in the future. So prepaid expenses are an asset. So make sure, again, I can just see that might be confusing to some people. Fixed assets, we already talked about. Okay? All right, so let's talk a little bit more about assets. Before I get to this slide, even though most of you maybe have this already, I don't know what I erased and didn't erase on the slides. Tell me Something else that's important about assets. What's their balance? What's normally their balance side? Debit. They normally have a debit balance, right? And do they disappear at the end of the year? No, they're permanent accounts. So again, I think some people get confused with this, permanent accounts versus temporary accounts. So I'll just give you a simple way of thinking about it. So we all have bank accounts, right? Okay. At the end of the year, if you have $150 in your bank account, hopefully you have more than that, but I know, some of us, we don't have more than that. It is what it is, right? On December 31st, you have $150. On January 1st, does the bank say, thanks? Thanks for that $150. I feel like we have a lot more money now. Do they say that to you? No, you get your statement January 31st, and it hopefully still has at least $150 in it, unless you took money out of the bank, right? Does that bank account ever go away? Not unless you close your account, right? And the balance just is what it is as you move forward in time, depending upon what you take out or you put in, right? So that's cash. Your bank account is cash. That's a permanent account. So if you ever get confused, what's permanent, what's temporary, think of your bank account. And then you think that's cash, that's an asset. So assets must be permanent accounts. Okay, they don't go away at the end of the year. Okay, so here is the definition of a liability. This is the big, long definition. Probable future sacrifices of economic benefits arising from present obligations of an entity to transfer assets or provide services to other entities in the future as a result of past transactions or events. Wow. I don't even know what that means. Okay. So, well, here we go. Probable future sacrifices of economic benefits. So something that I'm going to have to sacrifice in the future, like paying cash for something, right? From present obligations. So I have a bill, and I have a future sacrifice I'm going to have to make to pay that bill. Okay? I'm going to have to transfer an asset or possibly provide a service as a result of that transaction or event. So when you break it down, it actually makes more sense, but it's a very long definition, right? And I think the most important thing is it's a probable future sacrifice, right? Probable future sacrifice from a present obligation. That's really I think the most important piece there, okay? That's what a liability is. And again, I mean, a lot of these things in accounting I think are really intuitive, right? Like, if you're ever looking at a question, you're going, well, I don't know, what could that mean? Like, look at the word. Accounting is not trying to trick you. The accounting term, it's a liability, right? It ain't good, right? I got to pay it, right? Right, an asset, that's good, right? So you kind of know these words kind of make sense, right? They're not going to trick you with the terminology here, for the most part. So examples of liabilities. So when you see the word payable at the end of something, you're talking about a liability because you have to pay it. It's payable. It's a future sacrifice from a present obligation. So accounts payable, notes payable. Accrued expenses. This is another one that I think might be confusing for people. It has the word expense in it, but it's a liability. Accrued expenses. Accrued expenses are a liability. They're liabilities that we accrue at the end of the period, and we'll talk more about that in more detail as we move forward in this class, okay? We're just kind of doing an overview now. Salaries payable, interest payable. This is another one that I think can be confusing. Unearned revenue is a liability, but it has the word revenue in it, and I can see some of you saying, I think that must be an income account. Unearned revenue is a liability. Can anyone give me an example of something that might be unearned revenue? Rental security, right, or someone pays their rent in advance, right? Right, for sure. And any other ones, that's great. Subscription, yeah, subscription. What did you say? Gift cards, right. These are unearned revenue. Those are all great examples. So magazine subscriptions is probably like the commonly used one because people will pay their magazine subscription up front, and then the magazine company has revenue that they have to still send you that magazine for 12 months, right? If you order People magazine, you pay whatever number of hundreds of dollars, right? Hopefully you order like, Time, or I don't know, what kind of like The Economist or something I should be saying in this class, not People magazine, but whatever it is that you order, right? They owe it to you for a year. Or if you join the AICPA, they give you the Journal of Accountancy, right? You're paying for that. You're paying for a membership, but they also give you a subscription over the course of a year. So, okay. More about liabilities. So if assets have a debit balance, liabilities must have a credit balance, okay? And they are also permanent accounts, right? They don't disappear at the end of the year. Unfortunately, we can't say, as this is an example, right? You can't say that your mortgage at the end of the year, well, the year is over, I don't owe that money anymore, right? Unfortunately, you still owe that money the next day, right? Wouldn't that be great? You have $150 in the bank. You can take that as long as my mortgage ends too at the end of the year. That will be just fine with me, right? Okay. So we did our assets equal liabilities plus owner's equity. So I've gone over assets, I've done liabilities. So here we are in owner's equity. That's the third section of our accounting equation, which is our balance sheet. Right? Our assets equal liabilities plus owner's equity is our balance sheet, right? Those are the accounts that go on our balance sheet. So I put here, because again, I think depending upon where you've taken this class in Intro to Financial, some of you, have you heard of the term owner's equity versus stockholders' equity versus shareholders' equity? Have you heard, or have you only learned like one of those terms? So just to make sure that you've seen all of these, right? Many of you have talked, like your professor probably talked about the issuance of stock. Not all companies work on stock, okay? So if you're not a company that has stock, are you going to have stockholders' equity? No, you're going to just have owner's equity potentially, right? Or owner's capital, right? So this section, so these are terms that they're called. Owner's equity is the same thing as shareholders' equity, same thing as stockholders' equity, same thing as saying equity section of the balance sheet. The terminology just varies depending upon what type of company you're talking about. I should say what type of entity you're talking about, okay? You know, if you're talking about a sole proprietorship or a partnership, you wouldn't obviously have stockholders' equity unless you were incorporated, because then you have stock that you issue. What do I have here? The residual interest in the assets of a company after deducting liabilities. Okay, so this is like a definition. This is a definition of owner's equity. This is a very technical definition. The residual interest in the assets of an entity after deducting liabilities. Right? It's like just an equation, right? Assets equal liabilities plus owner's equity. If you subtract liabilities from each side, you get assets minus liabilities equal owner's equity. Therefore, owner's equity is equal to what's left, assets minus liabilities, which is what's left of your assets after deducting liabilities. That's just a very technical definition, right? Another term for that would be net assets. Okay? You'll hear that a lot. So equity is made up of, these are four really important things. Again, places I think that may be confusing to people, particularly if you haven't looked at this stuff in a while. Okay? So if you're looking at a balance sheet, in the equity section, you will see the following, depending upon the kind of entity that it is. You may see common stock. You may see additional paid-in capital. This has to be if you are a company that has stock. Retained earnings. What goes into retained earnings every year? Net income folds into retained earnings at the end of every year and accumulates there. So it's not just 1 year's net income, it's the net of all of your net income and losses over all the years that you haven't distributed. There's something called accumulated other comprehensive income. We're going to talk about that more. I think we touch on it in this class. You're going to talk about that more in future classes, for sure. It's AOCI, accumulated other comprehensive income. Distributions to owners are dividends, or dividends, depending upon, right? It's dividends if it's a corporation, but a partnership can make distributions to owners as well. And that also comes out, it becomes a reduction to the total in the equity section of your balance sheet. Okay, so these are all terms that you will commonly hear in the equity section of the balance sheet. Okay? Any questions on what I've talked about so far? All right, so we're going to go through a few more slides here, and then we're going to play a little game thing, a little exercise game. Okay, so yes.
Some things it's not on the slide.
Yeah.
Will we receive the whole thing, or?
You did. Some things are not on the slides.
Yes.
So the slides I send to you are not complete. You have to fill in stuff. It's to help you, to help you pay attention. Right? So the slides are not complete. They leave things out, so you need to pay attention so you can fill in what's in the slides. You should be writing, yes. If you haven't gotten that already, you should notice that there are things missing in the slides, right? Because that's one thing also. It's like as I teach here longer, I start to notice different things, right? If I give you all the information, then you don't write. And in my experience, writing helps you remember and helps you learn. So I want you to write, so I'm giving you some stuff because I don't want you to have to write all of this, right? I've also tried giving nothing, and then everyone sits there like, can you please not change the slide? And it becomes like very monotonous. So this is where I'm at now. Yeah?
So can you just go over distributions to owners?
Yeah, so distributions to owners. If an owner, you have owner's equity, right? You have the owner's equity section, and you have retained earnings in that section, right? That's the net income that accumulates over time. Companies may just decide to give dividends, right? Dividends are giving out some of that retained earnings. You make a distribution on your based on the net income, right? So where does that come out of? It's all part of this section, okay? So distributions to owners, except whereas other things like net income increases the equity section, distributions to owners decreases it, right? That's for a corporation. If you are a partnership, partnerships make money during the year and their capital accounts go up or down. You know, I'm Rebecca Bloch, comma capital. If we made $100,000 during the year and I was 50-50 partners with you, what's your name? Basil? So Basil and I are partners. We make $100,000 during the year. We take $50,000 each. I say, it's nice that it's sitting in that bank account, but I'd like that in my bank account. So I take out $40,000 of that. I leave $10,000 in, maybe for future investments in the company, right? I take $40,000 out. That's a distribution to me as the owner. Where would that make sense to come from? My equity, my Rebecca Bloch, comma capital account should go down by $40,000, right? It's a distribution to owner in the equity section. I just realized I never took attendance. Lucky you guys. I'll take it right after the break. So, yes.
A company like Ernst & Young, per se, when they have like 1,000 partners, do they all have that?
They have capital account balances that then that are maintained, and if they take distributions, then that would reduce their capital balance. Okay? So, all right, any other questions about that? All right, so more about equity. Equity accounts should have a credit balance normally, right? Just like liabilities, except if you have losses, right? If you post a net loss to retained earnings, over time, cumulatively you have a net loss in retained earnings, then it will have a debit balance, not a credit balance. So most of the time, you would hope that your equity accounts have a credit balance, but that's not always the case. Sometimes they show negative, right? Which means they have a debit balance. They're also permanent accounts. Anything on the balance sheet is a permanent account. So here, revenue and expenses, which are temporary accounts, they go away at the end of the year, but they really fold into the equity section. Okay? They're gone, they're in retained earnings at the end of the year. Okay? So they fold into the equity section at the end of the year. So I made this list of what I think are important terms. Here are important terms that you need to know. If you don't know, you need to know. Debit, the left side of a T account. Credit, the right side of a T account. So what normally has a debit balance? Tell me one thing. Assets normally have a debit balance. What normally has a credit balance? And what else? Owner's equity, right, except if you have a loss, right, over time, then that'll bring you to a debit balance. What else do I have here? General ledger. That's an important thing. So in a general ledger, will you see all the detail for one account, or will you see lots of different accounts? I think somebody said the right answer. It's data from the journal, right. So All right, so this is important. Let me make sure I go over this with you guys real quickly here. So what do you think the right answer is?
Well, it's the one account that has all the details.
Right, it has all the details from one account. So let me see if any of these were right here. This is always like a challenge, of course. That's like not going to write well. Let me see. Actually, maybe this writes well. Right, okay. So you make journal entries. Here's the problem with this both being down. I have like that much room to write, so we'll see how this works. So you make a journal entry, right? Let's say the idea that someone comes into a store and buys something, for $100. So you debit cash for $100, you credit some revenue account for $100, right? This is known as a general journal entry, okay? You have cash, you have revenue in the same place. I'm going to show you this in a different way. So we're going to do a couple of transactions here. So what happens next? You pay a bill for $50. You had a bill out, well, let's just say we receive a bill in the mail for $50 for utilities. Okay? So what would be the journal entry for that? Utilities expense. You received the bill, you haven't paid it yet. Accounts payable, right? That's okay. That's why we're doing this, right? So utilities expense, debit, credit, accounts payable, $50. Then you pay the bill. Debit AP, credit cash. I heard someone say debit cash. You have to get rid of that AP for $50 and credit cash. Okay, so let's just say that's all the transactions we have in that business. This is all general journal. Okay? Yeah, as they happen, there are general journal entries. And I'm going to talk with you more about general journal and subledgers and all of that. But now I wanted to do something different. Have you guys worked with T accounts before? Yes. Okay. So let's just do this here. So I've used cash, revenue, utilities expense, AP. So I need 4 T accounts. So we have cash, revenue, utilities expense, and accounts payable. So now, let's look at those journal entries like this in T accounts. So first we have we receive revenue for $100. We debit cash for $100. We credit revenue for $100. Next, we have utilities expense of $50. We credit accounts payable for $50. So, right, everyone with me in what I'm doing here? I'm just putting these journal entries here into these T accounts. There's a reason why I'm doing this. So accounts payable, now we pay it. So we pay the accounts payable, 50, and we credit cash for 50. So what's the ending balance in our cash account? $50 here. What's the ending balance of revenue? 100. What's the ending balance for utilities? 50 for utilities expense. What's the ending balance in AP? 0, right? Okay. This is your general ledger. These are all general ledgers. T accounts are general ledgers. If you make journal entries using T accounts, I can look at my cash general ledger and I can see a transaction for 100, a transaction for 50, and I have an ending balance of $50. Okay? So that's my general journal. This is my general ledger. So you make entries into the general journal. Technically, I'm going to tell you a little more about that, okay? You post them to your general ledger. Here is where they end up. And you know what? When you make a trial balance, the balance you see in cash is 50 in your trial balance. The balance you see in revenue is 100. The balance you see in your utilities expense is $50. And accounts payable has a 0 balance because these general ledgers are what directly would post to your trial balance. These are the trial balance numbers, okay? So when you think T account, think general ledger, okay? So when you think T account, think general ledger, okay? Hope that clarifies the ledger versus journal, okay? And if you need a little, like if that even confuses you, if you think of a T upside down, that kind of looks like an L, right? So you could think, if you get confused by that, that's general ledger, right? That's your ledger, okay? Just like little helpful memory tools. Okay, so T accounts, there you go. So I'm a step ahead of myself. So that's a T account. We know what those are. So when you think T account, what are you supposed to think? Ledger, general ledger. Very good. Okay. Journal entry. Where do we make those? General journal, right? Those are our journal entries right here. So journal entries always have to have both what? A debit and a credit, and they have to be equal, right? In total, they have to be equal. Okay? So I'll tell you as a funny thing, when I was looking through problems to do with you guys, the book gives all these things where like the trial balance doesn't balance. And I have a lot of trouble doing those problems because I'll tell you that it's not going to happen, right? It will never happen in the real world because your accounting system won't let it post if it doesn't balance, right? So what's the point of going through a trial balance that doesn't balance? I forgot, I'm recording here, but, oh well. See what I mean? I don't even know. But you know, just a little thing. We won't talk more about that. Oh goodness, okay. All right, well, accrual basis. So when we report according to GAAP, it's on an accrual basis. That means we record revenues when they are earned and expenses when they are incurred, right? We don't worry about when cash changes hands. Well, we have to record that, of course, but we're worried about when things are earned and when the expenses are incurred. Okay, that's the recording things on the accrual basis. You'll see things like accounts payable, accounts receivable, accrued expenses. These types of accounts on a cash basis you wouldn't see, okay, because you're not concerned with things that are payable if you haven't paid them yet if you're on a cash basis. Okay? All right, so U.S. GAAP. U.S. GAAP. What does GAAP stand for? Good, right. Good. Generally accepted accounting principles. So in the U.S., that's the rules that we follow. Do you know who makes those rules? The FASB. Actually, not the government, which is really glad you said that. We're going to talk more about that in the next class. You wouldn't have even learned this yet, right? That was just a bonus, right? So the FASB, the Financial Accounting Standards Board, makes our accounting standards. And it's actually the SEC. Congress created the SEC, right, after the Securities and Exchange Act of 1934, and they had the authority to make these accounting standards, but they delegated to the private sector. Okay, so ultimately the FASB makes these rules. The FASB didn't always make these rules. There are predecessors to the FASB that we're going to learn about next week, but the FASB makes these accounting rules. Okay, and they're a board. They take input from the outside. Again, all things we're going to talk about next class, right? But that's where GAAP comes from. Ultimately, not, from the FASB or its predecessors. IFRS. So it seemed like no one calls it IFRS, but you've heard of International Financial Reporting Standards. I call it IFRS. Some people call it IFRS. I like the way IFRS sounds better, so I call it IFRS. So you call it whatever you want. Okay. So International Financial Reporting Standards. These are reporting standards that are being used throughout the world by many countries. So countries, we have our U.S. GAAP. Another country might have its own local GAAP, right? But the thing is, we live in this world right now, we're in this real-time economy where we do business all over the world, right? You can see, if you look, they'll do news reports in remote countries and you'll see a McDonald's there or a Coke, someone drinking a Coke, right? Businesses don't just do business in one country, they do business all over the world, right? And if each of these countries has its own financial reporting rules, which may significantly differ depending upon many factors, some of them being the political climate in that country, some of it being the enforcement in those countries, some of it being, there's a whole plethora of reasons why financial reporting standards would be different. How are those companies supposed to report, right? That could be very confusing. So there's this initiative, and this is one of the reasons I say get the most updated version of the text because it's always changing. So the idea is that GAAP is converging with IFRS, right? So again, the European Union, if you are listed on the stock exchange in Europe, you have to report on IFRS now. Okay? People used to use GAAP or their own local, U.S. GAAP or their own local GAAP. Everyone's going to IFRS. The U.S. hasn't gotten there yet. The U.S. is on a road, has a roadmap to get there, where when I taught this class in a couple of years back, it was, we will be converging with IFRS. Everyone has to learn IFRS because we're going to be on IFRS, and IFRS is very different than US GAAP, so it was almost like you have to know GAAP, but you're going to have to know IFRS because like next week we're going to be switching, you know, that kind of thing. It was like you're going to be on one then the other. I'm not so sure that's what's happening now. So, you know, my sense is more that we're converging. So GAAP is changing and becoming more similar to IFRS, right? So maybe eventually we'll call it IFRS, or maybe we won't, but it'll be just like IFRS, right? And one of the issues too is that people use IFRS, but then they kind of make their own local version of IFRS, which is kind of just like everyone has their own standards anyway, okay? Now the big differences here, I mean there are many, many differences between GAAP and IFRS, but the overall idea that's different is even though we call these generally accepted accounting principles, they're known to be more rule-based, right? So what happens is, and a really good example would be accounting for leases, which you haven't learned yet, but I'll tell you a little bit about it. And I'll tell you, IFRS is more principles-based. So in GAAP, if you are accounting for, if you're looking at someone who has a lease out there, right? And you know, they have a lease for some equipment. Do you capitalize that lease as something they actually are going to really own? They actually kind of own it, or do you expense it as something that they are just renting over a period of time and you're going to return to them? Well, under GAAP, there's rules, right? They say, well, does the lease go for more than 75% of the life of that asset? Is the fair value of the present value of the future payments greater than 90% of the value of that asset? Is there a bargain purchase option at the end? Can you buy this? Will you be able to buy this asset for $1 at the end of the lease? They have these rules, right? And if you meet any of those, if any of these meet the lease, then it's a capital lease. You have to capitalize it, right? Then you can't expense it. So what can companies do if they don't want to capitalize something? They know the rules. They make them. They go, well, it has to be less than 90% of the present value of the future payments has to be less than 90%. We'll make it 88%, right? Is it more than 75% of the life? Let's make it 70% of the life, right? And so the auditor comes in and says, nope, they don't meet that, they don't meet that, they don't meet that. It's not a capital lease because it doesn't go by the rules. Under IFRS, they would say, nope, looks like a capital lease, smells like a capital lease, that would be a capital lease, no matter what you are trying to circumvent, right? So there's a principle-based versus rule-based. So that's a very big difference between GAAP and IFRS. Now, some people say that going to IFRS is a problem in itself because if you can use so much judgment, you can't compare financial statements. Everybody makes different judgments, right? And comparability, we're going to learn, is an essential part of the foundation of accounting, is being able to compare companies. So there are pros and cons to each of these, to rule-based versus principles-based, but that's just a little overview, GAAP versus IFRS. And you will be learning more about this. I believe that it's being tested on the CPA exam now, but I'm not telling you take a CPA review class, they'll go over that kind of stuff with you. So I'm going to be touching on IFRS in this class, but I was touching on it more when I've taught it in the past. I'm touching on it a little bit less now because we're refocusing a little bit more on GAAP now, okay, with the idea that it is eventually converging. And I will mention areas where GAAP used to be this way, but now it's this way because it's getting closer to IFRS, okay? Any questions on that, GAAP versus IFRS? Okay. So permanent accounts. We talked about that. All asset, liability, and equity accounts. That's exactly what I was just getting at, right? All of our balance sheet accounts are permanent accounts. That's really important. All of our balance sheet accounts are permanent accounts. So if I have permanent accounts here, what do you think is going to come next? Temporary accounts, which what are we talking about there? Revenues and expenses, which go on the income statement, right? There you go. So where did I say that all of these permanent accounts and temporary accounts ultimately get reported? Once you have a balance on the general ledger, in the individual general ledger, trial balance, right? All of that ultimately gets posted to the trial balance. And what happens once you have a trial balance? What can you make? An income statement, balance sheet, which are all types of financial statements. All types of financial statements. So, again, I mean, just walking you through here, I think, let me just see what I go through here today. I don't remember. I have the adjusting entries. Yeah, okay. So what happens is, that this is a good time for me to mention this. So I just actually very briefly, just kind of impromptu did this, right? This is during the period. You make journal entries for all the transactions that occur in your company. Make journal entries. That's just what happens in companies during any particular period. You make journal entries. And then those journal entries get posted to the ledger, right? And then in total, those numbers at any given time, you can make a trial balance based on what the ledgers are at that time, right? You can make a trial balance, right? So that's where we're at right now. You have entries during the period, they post to the ledger, and you can make a trial balance. So we're making our way through the accounting cycle, right? I said you're going to go through everything you learned in your financial accounting class. So there we are. That's where we're at so far, okay? But I'm just throwing in some other stuff too, right? So it's more than what you did in your last accounting class in 3 hours. Well, I don't know if we'll get through it all. We'll see. So debits. This is like a little mnemonic I just have here. Just little funny things I try to make up to help you remember stuff, right? So debits increase expenses, assets, and dividends. Dead. Dead. Debits increase expenses, assets, and dividends. What one do I think might be the thing that you may not remember as well? Is dividends. Debits increase dividends, right? Because as you pay out dividends, you debit your dividends account, right? Which is in your equity section, right? So debits increase expenses, assets, and dividends. Retained earnings, right. So debits increase expenses, assets, and dividends. Dead. On the other side, liquor. Dead and liquor. Okay? So what do we credit? We credit liabilities, income, common stock, capital, owner's equity, retained earnings, revenues. Liquor. Dead and liquor. Yes? As what? It's just, I made up the mnemonic, so it's whatever it happens to be. Someone else made up another mnemonic. There you go. Yeah. You could use whatever works for you. Just little things, again, just to help you remember as you're learning. Like I said, most of you have taken one class, maybe two, maybe not taken them for over a year. These are just things to help you jump back on the bandwagon, on the accounting bandwagon. Now you'll remember all this stuff. Okay? Any questions on anything I've talked about? Okay, so now we're gonna play a game. And the game is called, does a debit increase or decrease? Wait, no, but I'm gonna give you the item, right? It's not that easy of a game. Does it increase or decrease inventory? Debit increases inventory. Right. So I'm sorry this is tiny. There's a lot of them and I couldn't figure out how to, so it is what it is. Depreciation expense. Good. Accounts payable. Decrease. Good. Good. Sales revenue. Good. Common stock. Decrease. Because what kind of account is common stock? It has a credit balance, because what kind of account is it? Equity, right? And equity accounts generally have a credit balance, right? Unless you're dealing with a loss. So when you issue common stock, you would increase it with credit, decrease it with a debit. Wages payable. Good. Cost of goods sold. Right. What kind of account is cost of goods sold? Expense. Good. Good. Utilities expense. Increase. Good. 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 Haven't talked about this one. Allowance for uncollectible accounts is what kind of account? Contra asset account. Is it a contra asset account, right? So, oops. So, it would decrease, right? Allowance, so you just think it's a contra asset. So normally debits increase assets. If it's a contra asset, then it would do the opposite. It would decrease it, right? What is it a contra account to? Accounts receivable, right? Allowance for uncollectible accounts is a contra account to accounts receivable. That is the account. So, yeah, so what you would use that for, so I'll give you an example. I mean, this is, when we go through accounts receivable, this example is not that valid, but it's a kind of simple example, so I'll give it to you anyway. So when I was working as a controller, we had set up accounts receivable for rent for various tenants. There was a tenant in there that never paid its rent. And it was kind of an affiliated company to one of the owners. So we let them stay in there, and they didn't pay their rent, and eventually they moved out. And we didn't know if we were going to ever get any money for them from rent. So we set up an allowance account. We basically wrote off, it's like writing off that accounts receivable. Setting up an allowance account is saying, I don't expect to receive certain receivables. Although the reality is you don't really generally do it on a case-by-case basis. What companies tend to do is say, we estimate about 2% of our receivables won't be collected, so we set up an allowance account for about that 2%, right? Because the reality is your financial statements are supposed to show revenue earned, expenses incurred, right? Not necessarily when cash changes hand. So when you have receivables set up, you know at that time a percentage of them are not going to be receivable. You have to account for that as an expense at that time, as bad debt expense at that time. So maybe a lot of the reason some of you guys were saying contra revenue is because you're thinking of bad debt expense, which is the other side of that journal entry that you would make.
So it's basically like an assumption before it happens.
Right. You have to set up an allowance account for receivables that you don't expect to collect, not at the time that you know you have to write it off. Not at the time that you know you're not collecting. Okay, so the reason I said my example wasn't a great one is because generally companies don't work like that where they write off a specific guy. They just set up these estimates. Okay. All right. Bad debt expense. What does a debit do? Increase. Right. It's an expense account. Debits increase expense accounts. Good. Interest revenue. Decrease. Good. And last but not least. What kind of account is gain on this gain? It's a kind of revenue account, right? It goes on the income statement. Decrease, right? Okay. And we're going to go over this later, but I'll tell you now so that I can repeat it later, so then you'll be more likely to remember it. A gain on the sale of equipment. So we have revenues, we have expenses on the income statement, and we also have gains and losses. Can anyone tell me what the difference is between a revenue and a gain? Why we call them something different? Yes?
Revenue is like if you make like a sale on something,
Mm-hmm.
and then a gain would be like you acquire something, not necessarily through a sale.
Yes, you're like right in the right realm. I'm going to add a little something to that. Yes, that's right. That's kind of what you're saying via example, right? The revenue that you earn is through operations. You may peripherally, I don't know, name a kind of company. Pepsi. So Pepsi makes sales on soda, right? They may own a property and sell that building, right? But that's not what their primary business is. So they may have a gain or loss on the sale of that property, but that's not part of their primary business. That would be a gain or loss on the sale of some equipment. That's exactly what you were saying via example, right? So you got it. I just want to kind of point that out, because again, other areas I think you can, easy to forget as you're not doing this accounting stuff. So, okay. So now what I'd like to do is look at an exercise. So those of you who have a book, we're going to be doing exercise 3.1. So what I'm going to try to do now is figure out how to put 3.1 up here so you can actually do it. If you are sitting near someone who has a book, like make friends so at least you can get started on exercise 3.1. But in the meanwhile, I'm going to spend a couple of minutes trying to figure out how to get this to work. But again, so here on the second, they invested $30,000 in cash and equipment valued at $14,000 in the business. So again, I just want to make clear, this is from the perspective of the business, right? This is the business's books. So if you invest cash into the business, what happens to the business's bank account? It increases. So therefore, the cash account has to go up, and an asset has, what side is the increase side? The debit side. That's why you see we're debiting cash. It's the same for equipment, right? They're investing equipment. You can put, and think of this, don't think of this as like rules. Think of this logically, right? If you decide to start a business, right? I think I gave the example to someone up above here. You want to open up you want to buy a building to open up a gym, okay? You need money to buy that building. So you say, I'm going to invest money in this business to help buy this building. You're going to put money into the bank account of that business. That increases cash, and that becomes your stake in the business. That becomes your capital that you've invested in the business as up to that point, okay? So debit cash, debit equipment, credit owner's capital. On the second, they hired a secretary at a salary of $290 per week, payable monthly. So does anything happen when you just hire somebody? No, they didn't earn any money yet. You don't have to record anything right there. They didn't earn it. Unless you really have a sweet deal. Right, exactly. It's your advance, right, when you start. You're signing, unless you have a signing bonus, you're not recording anything, right. So on the third, purchase supplies on account for $700. Because it's on account, you credit accounts payable. Now here, we're debiting supplies. It says to debit an asset account. The idea here is that they're capitalizing the supplies and they'll expense them as they use them, okay? So the reality is, I'll just give you a little real-world infusion. I've never been at a company that capitalizes their supplies. You just put it in supplies expense and you move on, right? Because who keeps track of these little things when you have a lot of things going on, right? You're a little, like, we used a pen. Let's credit supplies and debit supplies expense. It's like cost benefit, you know, of the information. But here they want you to debit the asset, okay? So on the 7th, paid office rent of $600 for the month. So here, when you're paying rent, you want to charge rent expense. And again, this is all logical. If you're thinking, the terminology is just logical according to what the situation is. So you credit cash. Next, on the 11th, completed a tax assignment and billed the client $1,100 for services. So here, you actually did the work, so you have a receivable and you've earned that revenue for $1,100 because you've actually done the work already. On the flip side, somebody paid you in advance on the 12th for $3,200 for a management consulting agreement. Have you fulfilled your responsibilities yet? But you've received cash in advance of that, so you have revenue that has not been earned. So you have unearned revenue, which is what kind of account? A liability account. Right, it's a liability account. So here you debit cash, credit unearned revenue. Received cash of $2,300 for services completed for Ferengi Company. So received cash for services rendered. It's another debit cash, credit revenue. On the 21st, paid insurance expense of $110. They're not telling you you've prepaid any insurance, so you just debit expense and credit cash. You paid it. So again, just terminology for those of you who haven't seen this in a while. When you pay something, you're either paying cash, you're writing a check, okay? You're paying it. You have to impact cash. If it says you've done something on account, have you paid it? No. So you should never charge cash if it's on account. You would charge either accounts payable or accounts receivable, depending upon whose account it's on, right? If someone bought something from you on account, it's receivable, right? If someone If you bought something on account from someone else, then it's payable. Right, you got it. Okay. And on to the next. Paid the receptionist, $11.60 for the month. Debit expense, credit cash for the $11.60. Account of supplies indicated that $120 of supplies had been used. So now they come out of supplies and into supplies expense. Now they're expense as they're used up. And on the 30th, purchased a new computer for $5,100 with personal funds. The computer will be used exclusively for business purposes. So what this is saying, yeah, the owner is investing. So let's think of it. Let's think of this in the simplest of ways. Let's not think of it how it happened. Let's say this business realized that they needed a computer for $5,100, and it was going to cost $5,100, and they didn't have that. So the owner said, "I'm going to put $5,100 of my own money into the bank, and then the business is going to go buy a computer." Right? Would that make sense? Right? To do that? So what would happen then? What would be the journal entry? So the owner says, so they figure out, we don't have enough cash in the bank, but we need to buy a computer. The computer that I found is going to cost $5,100. We don't have any money in the bank. So they're going to invest. He says, I'm going to put $5,100 into this business. So he's going to debit cash for $5,100, and he's going to credit owner's capital, because he just invested more money in the business. Then what's going to happen? He's going to buy a computer, right, for $5,100. So what's the journal entry that you're going to make for that? Debit equipment for $5,100, and what are you going to credit? Cash. Right, cash for $5,100, right, because you already did the owner's capital, right? So net, let's look at these two journal entries together. Cash is netted out, right? You increase cash and you decrease cash. So the net impact of this journal entry is a debit to equipment of $5,100 and a credit to owner's capital of $5,100. So alternatively, and more, even though this is, I think, a clearer path, the owner could say, a computer is needed by this business. It's going to cost $5,100. I'm just going to go out and buy it and give it to the business. It does the same thing. It just saves a step. Does that make sense? No? Where are you getting stuck? Tell me.
When I saw that last entry, I just debited the equipment $5,100 in cash because it's going to be used in the business.
But had the cash get into the business? This person took it from their personal funds. If you read what happened on that date, it says he took it from his personal funds. So let's say you own a business. You have a business bank account and you have your personal bank account. You cannot mix those two things, right? When you report as a business, does your personal bank account go on the business's books? No, only the books of the business, right? Only the bank account of the business goes on the books. So if you spend $5,100 of your own money, is that going to show up on the business's financial reports? No. You have to get it there, right? So there are two ways of doing that. One is by actually taking the $5,100 and putting it into the cash account of the business, and now you've made an investment of $5,100 more into the business, right? And now you buy the computer. Or alternatively, you can buy it on behalf of the company and now just have equipment, give the computer to them and say, I've made a $5,100 investment in the company. Give me a $5,100 credit to my capital. Okay, does that make sense? Okay. Any other questions on that transaction? Yes?
On the exam, when you put out credit first, do you get points on? Sometimes I could.
You should always put your debits first. In the real world, people make journal entries that are debit and then credit. It's not to say that it's going to post anywhere incorrectly, but you need, for good sound accounting, you need to put your debits and then your credits. You need to do that. You just need to practice that and make sure that you do that right. Okay? And I get that the debits and the credits are all going to go to the same place, but you're not going to, if you make credits and debits, it's going to confuse people. Don't do that. This is just an accepted way of doing journal entries. Okay? Debit then credit.
How about equipment? type of equipment we have to write, like computer and installation plan? Because
What do you mean?
for the first transaction, we had invested equipment.
Yes, but that's an account.
Yeah.
An equipment account can have all sorts of different equipment in it.
I'm just saying, if just in an exam, just write equipment, you don't have much equipment.
Don't worry about that. Don't overthink that, right? So equipment, like in the real world, there may be, some people may have multiple accounts for different kinds of equipment, some may not, depends upon the kind of business. Don't overthink this, right? We're putting it all in an equipment account and it's fine, okay? All right, so any other questions on these journal entries? Is that like a good refresher, like getting back into journal entries? Okay, so now what we're going to do, I said we went part of the way through we've been part of the way through the accounting cycle, right? So we made general journal entries, right? Now we have to post to the ledger, and from the ledger we can make a trial balance, right? So here I just put up an example of a trial balance, and I want to point out some of the these numbers, like this comes from nowhere. Don't worry, this doesn't relate to anything. I just found a trial balance and I put it up, okay? So what's really important about a trial balance? That it balances, right? It's right there in the name. Like I told you, accounting is not trying to trick you, right? If you're going like, trial balance, it must mean there's something, no, it's like just real, it's that simple, right? A trial balance has to balance. The debits have to equal the credits. So there's a couple of things I want to point out on this particular trial balance, which will not hold true for where we're at in the accounting cycle. Actually, I'm going to ask you, is there something that somebody notices that's missing from this trial balance? Not, all right, dollar signs, okay, but that wasn't what I was looking for, but okay, yes.
Supplies.
What is it?
Supplies.
Well, this is not an example from the one we just did.
Revenue.
Yes, revenue.
I would say deferred stock.
Yeah, I'm talking about revenue and
Expenses.
expenses. That's what's missing here. What those temporary accounts are missing. What does that mean? It's not that you have no income. Somebody, I think, said it. It's what? It's a final trial balance. We haven't gotten there yet in the accounting cycle, but you did this in your financial accounting class, or at least I hope you did this, right? When you have a post-closing trial balance or a final trial balance, you've closed out your temporary accounts, and it's all sitting here in retained earnings. Okay? So your trial balance is still balances because all of the every revenue account and expense account every number is there, it's just in here. So this is a post-closing trial balance, and that's how you know because there's no revenue and expense accounts here. But where we're at right now, I just wanted to show you a trial balance. I happen to have chosen a post-closing trial balance or a final trial balance to show you. But what I'd like you to do now is make a trial balance of the journal entry from the journal entries that you just made. So you made general journal entries, you can post them to the ledger in your T accounts, and then I want you to make a trial balance from those journal entries. Right, but it's not a post-closing trial balance. It should include revenues and expenses. So it is not going to look just like this. It will have revenues and expenses in your trial balance, incorporated to your trial balance, okay? So again, now we made our general journal entries, we posted them to our ledger, and then we made a trial balance because I thought that. So we got through, before the break, we got through setting up, we did our journal entries, we did our posting to the ledger, we did our trial balance. So now you have a trial balance, but now we have adjusting entries that have to be made at the end of the year, either for errors or accruals. For various reasons you make adjustments at the end of a period. So we're going to go through some of those adjusting entries that we might make. So here, salaries. This is a very common accrual that's made at the end of the period because very frequently payroll happens not on December 31st, not at March 31st when the quarter ends, okay? Not at the month end. It might just be every other week, okay? Or whatever it happens to be, the payroll comes out several days after the end of the period, okay? Sometimes payroll is it might be 2 weeks after the end of the period. So what happens is, just because you get paid let's say you have a December 31st year end. Let's say you get paid January 5th, but you've been working since December 20th, right? So December 31st comes around, you've earned 10 or 11 days of salary, right? So even though you haven't been paid for it, you've earned that salary through the end of the period, and that company owes you that money. So if you were to leave as of December 31st, they would owe you 11 days of salary, right? So what happens is you have to accrue those salaries at the end of the period via journal entry. So you haven't received your payroll yet, but you still have to accrue that payroll. So this would be the type of journal entry that you'd make for your payroll. You'd figure out how many days have gone by, what your payroll normally is. You figure out how many days have been earned by your employees as of the end of the period. And you debit salaries expense, you credit either accrued salaries or salaries payable for that amount. Okay, so that would be one type of adjusting entry. So you've made a trial balance already, but you can make a trial balance at any moment, right? We made a trial balance, but we didn't accrue all this stuff. We have to accrue the salaries in order to be properly on the accrual basis in accordance with GAAP, right? Because we have to recognize revenues when they are what? Earned, and expenses when they are incurred, right? So we've incurred, in my example, 11 days of expense, but we haven't paid it yet. So we have to record the expense when it's incurred. So that would be as of the end of the period. You may have receivables and revenue that have to be recorded. So let me give you another typical example why this is here as a month end, as a period end accrual. What a lot of companies do is they work on a cash basis. And then at the end of the period, they put themselves on the accrual basis. Just for the end of the period. So how can let me see if I can give like a simple example here. So what many companies, what happens is, so I'm the controller of a company. I have somebody who works for me in the billing area, and I have someone who works for me in the payables area. Generally what happens is, the person in the billing area doesn't really, I shouldn't have said billing, I should say like collections area, right? They receive cash, and they record it as revenue. Right? That's what they do. They bring in cash, they make deposits into the bank, and they put it in as revenue. They record the revenue and that's their simple function. That's what they do. Okay? Money comes in, they make a deposit, and they make a journal entry, or somebody else makes a journal entry to record that revenue. Okay? If you have proper controls in place. So at the end of the period, we have to look and say, is there anybody who hasn't paid us who owes us money? Okay, so for example, you think of, it's funny, I say it's like every time I teach this class, I always end up giving examples of a bagel shop. That's like always the first thing that pops into my head. It must be because I eat so many bagels. So it's like the first store that comes into my mind is like, oh, I'll just talk about a bagel shop, which is like kind of silly, but I'll just use that as an example, right? Because why not, right? So, so if I'm a small bagel shop, right? And people come in, they pay me in cash, and that's the end of it, and I have my sales that I make. But I also have some customers that are companies, that are local companies. And they buy stuff from me, you know, and I give them, I extend credit to them, basically. I say, you don't have to pay me for like 30 days because, you know, that's how, if they had to pay me right away, they might not buy stuff as frequently, right? And this is how I have this goodwill with these companies. I extend them credit and whatnot. So at the end, normally what I do during the period is I just record revenue. I don't bill them and then record it as a receivable. I just like create a little invoice on Excel or something and I send it out to them. At the end of the period, in order to be in accordance with GAAP, I look at all the people who haven't yet paid me. I look at all my invoices that are not stamped paid. And then I input them in a journal entry, and I debit receivable, I credit revenue. That puts me on the accrual basis. See? So I just do it once at the end of the period. I don't do it consistently throughout. You get it? Make sense? That's what a lot of small companies do in reality, because they don't care during the period about who they bill. They have a little system. They have a little like 3-ring binder. They put the invoices in there, and then it's just like stamp it paid, you know? They're not that, you know, this is what a lot of companies do. They're not that sophisticated. They just record it at the end of the period. Yeah, I mean, I don't want to say it's just small businesses that do that. Large businesses tend to bill and then they charge they debit receivable credit revenue as they bill, right? So in a larger company, you'd be less likely to see that. But many small companies, and there are many small businesses, and there are even some medium-sized businesses that just aren't that sophisticated. This is how they work. Yes?
There is some limitation, yes, for companies to use cash.
I mean, what they're doing, yeah, like these companies for the audit purposes would go on the accrual basis, but they may be cash basis during the month. Right. So yeah, of course there are limitations, because at any given moment in time, you can't print a report and see who owes you money and how long they've been outstanding. There are many limitations to doing business this way. I'm just letting you know that this is what happens sometimes. Okay, that many companies work this way. So these are accruals. Adjusting journal entries. So another thing that happens, and this happens, I would say, in big companies, small companies, you know, this is very common, right? Do I have as an example here? Let's see. Okay. I don't even have this as an example. So adjusting journal entries for prepayments. Let's just start here, and I'll give you the other thing I was going to tell you after. So the cash flow precedes the recognition of the revenue. So you pay your insurance up front for the period or for the year. You make one journal entry, prepaid insurance, you credit cash. Believe me, you do not every week adjust that prepaid account and say, oh, well, I've used some of that up. Again, that's just not how people work, right? You make these entries at the end of the month, probably, at the end of the period. You don't probably maybe you do them at the end of the year, but if you do any kind of reporting with frequency, this would likely to be, you ever hear people say, oh, it's the month-end close. What a pain. These are the kinds of things that they have to do. They have to adjust all these accounts to put them to their proper balances. They're accruing things that they didn't accrue. They're putting themselves on the accrual basis if they haven't been. These are all the things that you have to do at month end to get your books to look that they're properly in accordance with GAAP. Okay, so here, here's the initial prepaid. Here is the journal entry that you would make to expense some of that. So here's what you recorded at the beginning of the year. Here's what you record at the end of every month to expense a portion of the prepaid. If you're like the magazines, which is always that common entry, that common example, okay? People gave some other really great examples. I just think magazines is like very simple to think about. You would debit the unearned and credit the earned revenue, right? As you earn that revenue, if you're the person selling the magazine, right? You have to recognize that revenue at the end of the period. Any questions on what I'm talking about so far? Okay. So other adjustments. I've mentioned this earlier. You have these different estimates that you have to make at the end of the period. And again, you don't just say every time you get a receivable, well, what percentage of that specific receivable do I expect to be uncollectible? I mean, you'd be sitting there making a million journal entries. These are the kinds of things you do at the end of the period. You take a look, you evaluate your receivables, and you would adjust your bad debt expense in your allowance account. You might do this at the end of the period. You might do this at the end of the year. But this would be an adjusting entry that you would make. You would not do this as a regular entry during the period. And last but not least, depreciation. Now this is a funny one. I mean, in the experience I've had, so you have to record depreciation on your fixed assets. People have these, some people have very sophisticated fixed asset systems, and a lot of places have big, long Excel spreadsheets of like every asset from the beginning of time that they don't even, necessarily know where they're all at, but that's a whole nother, won't even get into that. But you have to record depreciation on those assets. So you calculate it, and you make a journal entry for it. Many accounting systems don't have a separate module for fixed assets, right? You have to record that somewhere separately. Very sophisticated. If you work for a large corporation, that may be different. But small, medium-sized businesses tend to have some other method for having to just track their fixed assets, pick a depreciation method, record it, and this would generally come right before the auditors are here, right? If you're not reporting, if you're not some kind of a public company reporting, you don't necessarily depreciate your assets. You depreciate when you're reporting to outside investors or creditors or the auditors, something like that.